Hey, it's Soleil, and this is episode 446 of the Orange Pill Investor, and we don't want no short people around here. Um, Ben said it right last night. We need the shorts to get blasted, and that includes all of my that includes all of my covered calls. I am positioned with so many long calls at this point. I would be grateful for a nice short squeeze and have all of my shorts blasted through. What's up, Dana? What's up, Howard? Yeah, unfortunately, the shorts are winning, um, which would be okay if I was a pure covered call seller like I used to be. But I got infected by the Quant Bros virus and started putting on as many long leveraged positions as I could stomach. What's up, Grit? And so I'll get into the Grok, the Grok foo that I did. I asked Grok what would be the optimal ratio of like keeping some dry powder, like mixture between cash and strategy. And I thought, well, since STRC is going to be better than cash, it's going to be a stable coin plus interest. I thought for sure that's got to perform better than cash, and it does. But it was quite the interesting result, not what I was expecting. But before we get into that, I should have closed this Tesla position earlier this morning. Definitely going to get wrecked. So I put on this earnings trade yesterday, trying to, sell right before the close. And there's two ways to play this. I lost the bet because I have I've got the 310, 300 strikes. What account did I do that in? Reddish? Yeah, here. No. Pink? All right. I'll just do it this way. Hopefully I can find the damn thing. Yeah, this guy. So I had sold this for like 160, tried to close it for 80. Unfortunately, Tesla crashed. Not really like super crashed, but down like, I don't know, 10% or something after earnings. Even though, they had the Cyracab rollout. And that's the thing, like the stock market is just completely irrational. So I'm going to cancel this working order. And let's see if I can find my frickin' put credit spread. Here we go. So this one is for tomorrow. And unfortunately, I sold it for 160. And now I'm going to try to close it. And I'm going to have to pay like $500. Now, there's two ways to play this. Generally, you put it on before the close. You take it off after the open. So I would have taken this off maybe at least by like 10 a.m. Eastern this morning. And that's just because like Ivy Crush isn't going to crush any harder by tomorrow. Now, the fact that Tesla did kind of bottom out at around 300 and then kind of clinging on for dear life, I could make basically like a 50-50 bet that Tesla will kind of recover tomorrow and maybe close above the 310. But that's not really making an earnings play at this point. Like the earnings play is already done and over with, and it's a loser, which happens. And so now it would just kind of be like, okay, do I hold on to this? Because this is basically a coin flip at this point. And do I try to let Tesla maybe creep back up a little bit? And that could happen, or just as likely, if I flip tails, then this could go against me, and instead of losing, the $500, I could lose the full 1,000. So I'm just going to cut bait, right? There's a lot of times people just find stomaching losses too painful, and they try to just, how do I roll this and make this not lose money, right? How do I revenge bet my way into not having to deal with the pain and suffering of making a bad trade? But I think more often than not, it's better to just realize that you win some, you lose some, and so I'm just gonna pay. I'm gonna pay my penance, and hopefully the law of averages will work out in the long run. So getting that out of the way, that's the only thing that I have to trade today, because that trade needs to come off. But here's what Grok told me. So I've got a bunch of stuff up here about what's the proper strategy to STRC ratio, and it was giving me kind of like a 70-30, but this was to mitigate some downside risk. It wasn't this wasn't optimized for pure profit. And so then the question that I really wanted answered was, is there a way to, is there a ratio of MSTR to STRC that would deliver, better than 100% return in strategy, right? If Bitcoin is the hurdle rate, you got to beat Bitcoin. And then if an asset is supposed to deliver better than Bitcoin, well, how would strategy do that? Okay, well, they take on intelligent leverage. They make money with their business intelligence software. And you should expect that the Bitcoin will deliver a return, and their financial products, their business software products, should also deliver a return. So you should get Bitcoin plus by investing in strategy. And if you don't, then you should find something else to invest in. Cue the not financial advice video. And so I'm thinking, oh, okay, well, maybe you just got to go like 90-10 or something, right? That's what I'm thinking. But instead, Grok told me that you can get bigger. The only way that you can get more strategy returns is to leverage strategy, which is hilarious, because that's the same way that Saylor said is the only way that you can beat Bitcoin is to leverage against Bitcoin. He had those interviews where he was talking about, get a HELOC on your house, and get a signature loan, and just anything that's not tied to Bitcoin's price that you can just get. And as long as your Bitcoin is unencumbered and you can't get a margin call, shit like that. And Grok is basically telling me to do the exact same thing with strategy. And I just thought that was kind of comical and fitting. So I'm just going to scroll past all of the frickin' math. And come to find out, Grok is recommending to outperform strategy. The optimal performance would be to short, or basically take a leveraged STRC position and get an extra 24% strategy, and that would increase the returns. So I just kind of thought that was hilarious. I'm not gonna do it, but thanks for the not financial advice, Grok. Of course, Grok does the not. Grok also gives us the NFA disclosure. So not really what I was expecting. And sometimes you go out to set to find the answer for something, and you set up your prompts, and you try to get Grok to give you the answer you want to hear, and then you get something else. I think this answer was kind of better. It doesn't mean that STRC is no good. It just means if you don't care about risk and you're just about the degen life, then you can just lever up. It probably would have said very similar things about STRF and STRD. Not really sure about STRK because of the call option there. But when I saw STRC come out, I thought, oh, okay, well that's the perfect way to think about holding dry powder to buy the dips, because it's going to be a stable coin, right? It's going to be $100 a share. One share would be like just holding onto a $100 bill and keeping that as dry powder, but you're going to be able to collect some interest on the top of that. So I would say this probably doesn't even keep up with inflation, right? It beats the official inflation rate, but I can't imagine that inflation is really under 15%. I think that's kind of unreasonable to imagine that inflation is anywhere close to the official numbers. So kind of thought that was interesting. We'll check the chats, see what we want to talk about, and then I will take some new Tesla positions because I took a bunch of long positions that got hosed overnight. And so now I need to take some shorts. How could you, Grok? I know, it's just so rude. STRC is not even available and Grok's telling you to short it already, which I thought was really crazy because I'm like, well, wait a minute. If you short STRC at 100 and then you pay interest on it because there is some carry cost, and then you have to deliver those STRC shares back to the lender in a year, 2 years, 5 years, whatever the time period is. If it's pegged at 100, like, you literally can't win that bet, right? You're going to borrow them at $100 a share, and then later on you're going to return them at $100 a share. But to a certain extent, if you're borrowing at under 9% and assuming that it continues to pay at least 9%, probably will go down a little bit as the Fed rate comes down. But at the same time, are the margin rates tied to that as well? So maybe even the margin rates would come down. I'm not really sure about that. So that's just me talking out of my ass. But as long as your margin is anywhere under 9%, then yeah, you're basically being paid to borrow this money. And unless MSTR screws the pooch on STRC, there should be very little margin risk with borrowing STRC because it's supposed to be stable. So I don't even know if it's going to be marginable when time comes to be able to own the damn thing. But it kind of blew my mind. It was like, okay, they're telling me to short something that you almost literally can't make any money shorting. But the whole point is that you can borrow money and lose money on it, right? You can pay interest on holding STRC for however long. And as long as the interest that you're paying is less than Strategy's CAGR, then you're going to be good. Which I think we kind of already knew that. There's plenty of people that have been borrowing on 0% interest credit cards, which, when I do that, I have to pay a balance transfer fee. So paying 0% for me is usually more like 4%. I've talked plenty of times about, I did borrow some money on my HELOC. I borrowed money against my paid off car. I got a couple of signature loans, and all of those have basically paid off just fine over the last year and a half. So this isn't really a new concept. So I guess I shouldn't have been surprised, but I was kind of shocked that that the amount of STRC that Grok told me to purchase to get maximized returns was negative. It was a negative amount of STRC. What's up, Michael? Let's see. Been thinking about this. Josh Man can be right. If strategy continues printing shares, MSTR price will just stay between 400 to 500 or lower. Our calls are going to get killed. So that could happen, but that kind of assumes that the 4-year cycle is over. If Bitcoin goes to 150 or higher, it would be hard to imagine a situation where any amount of ATMing could hold Strategy's price down, especially as the preferreds are going to be increasing the Bitcoin holdings, which increases the floor that Strategy can even trade at. So for Strategy to just trade sideways is hard for me to imagine. I guess we should all consider that it's possible, but I don't see. Priced at 90, free 10%. Yeah, for sure. The IPO is going to be, it's almost going to be like handing out free money. Do you consider moving your calls and turning them to shares, avoiding theta decay? Yeah, I do that every time they are under 90 days because that's when theta is going to start creeping up. So I almost never let calls expire worthless because I never let them expire. Now, my June and July 1080s lost about 90% of their value. So I'd be $35,000 richer if I hadn't bought any of the June and July 1080s and just bought shares instead. So absolutely. When you I might be crediting the wrong person, but I think Ben says it this way too. It's like when you put yourself on a clock, you're introducing that extra bit of anxiety, like you have to win by that date. But as a long-term investor and someone with low time preference, just owning Bitcoin or just owning shares themselves lets you just not really have to worry about the ups and downs along the way. You really only have to ask yourself, has your thesis changed? And it's kind of funny to imagine where we are today, where people complain so much about the ATM, because when they announced the ATM on the common shares to begin with, the price went through the roof. Like everybody was like, oh my God, please, yes. Sell Strategy at 2 and 3 MNAV and buy Bitcoin with it. Like, please do that. And then 6 months later, it's like, please stop doing that. But I do get Josh's point. I would like to see some shorts actually absolutely get demolished. My shorts included. That would be just fine. Because when the March and November pumps happened, I kind of started switching up my trading strategy to have enough uncovered long positions that I should be able to at least break even or at least profit. I won't 10x my portfolio the way that I have it constructed, even if strategy were to, if Bitcoin and strategy doubled right now in price. If I just had long calls, I could probably 10x or something, but I probably have it configured right now that I might, if strategy doubled, I might 3x my portfolio instead of 5 or 10xing, and I'm fine with that. Howard, let's see. I think you can find cheaper money than shorting a 9% dividend payer. Probably. You tell Grok that. I mean, Grok can only work with the prompts I give him, right? What's up, Brendan? What's the logic behind Grok's idea? It's like shorting a stable coin. Wouldn't you have to pay those dividends back as well? No, you'd be in possession of the dividends. Wait, that's a good ass question. So if you borrow stock. No, I'm sorry. Okay, yeah. So if you officially shorted it, you'd be borrowing it and then you'd be selling it. So you wouldn't even have, so I guess I effed that up. So you wouldn't even have possession of the stock to collect the dividends. So I bumfugled that. Yeah, you're not even going to be collecting the dividends. The person that you sold them to would be in possession of the dividends. You would just end up owing whoever you borrowed them from, and they're going to have to charge you more than 9%, I would think, because they're missing out on the dividends themselves. So why would anybody even loan out their STRC shares for less than like 10% for any reason? Plus a little bit of extra risk involved there. So Grok got a little bit of explaining to do on that one. Clearly, I still don't even completely understand the trade. Yeah, but everyone, you gotta check AI sometimes, because sometimes they give you wacky results. Short STRC, you owe the dividend to FDAT. Yeah, I think that's what I think that just started to sink into my brain. I don't know if you'd owe the dividend. Well, technically you kind of would, because whoever's loaning them to you wouldn't loan them to you for less than what the dividend would cost. I guess unless you agreed to pay it back before the dividend came up due, like some kind of super short-term thing. If anything, you could technically borrow near the risk-free rate using a box spread and collect the spread by buying STRC with the proceeds NFA. I hope that NFA shit disclaimer really, really saves my bacon, but who knows? MSTR has 1.6 MNAV. If Bitcoin is a 150 plus, then MSTR MNAV approximately 1.2 at 450. Yeah, so MNAV would have to really collapse in order to trade that sideways, which it's possible to do. But I don't see that happening unless we're in a bear market. Yeah, so you would owe the dividend. Shorting it makes no sense. So maybe what we're learning here is don't just take everything that AI tells you as gospel. Heard that trading options is multiplying what you don't know with when you don't know it. Sailor needs to test the buyback option so the AI learns what happens. If you short a dividend stock, you do pay the dividends. Damn. That's brutal. What's up, Scott? If you short a dividend pair, you pay the div, short SPY, and watch what happens. I'll just take your word for it. I love how this company releases wild securities and leaves the entire community in shambles trying to figure them out. Yeah, it's when they came out with Strike, I was like, what in the hell is happening here? And then, STRF was like, okay, this kind of makes sense. Just straight interest. And then when they came out, just more and more, STRD, I was sitting at the airport ready to take a flight and just reading it and listening to the presentation. I'm probably listening to the presentation 3 times straight in a row, and just trying to piece it all together. I kind of thought that STRD was a rug pull at first. I'm like, why would you come out with a similar product to STRF, but with it being lower in the stack and the dividends not guaranteed, it kind of ups the risk profile. So it's truly a different Truly a different product. Pay back the div before div due is the trade. Yeah, so that would be like, well, that would be hard to do with STRF because it's monthly. You could time it just right, maybe with like an STRD. But you totally should short when strife is greater than or equal to 110. Yeah, that makes sense. Short STRC at 100, 9% div, long STRF at less than 110, 10% div. You know what's funny is, even as bad of shorting this would be and paying the div to someone plus the margin cost, Strategy's compound annual growth rate is still probably high enough to make up for it. So Grok's probably technically still right. But there's got to be better ways. There's got to be better things to margin than well. So Grok actually said to short it, which technically means you borrow it and then sell it. But borrowing using margin, you'd still retain the shares and be collecting the dividend. But you know, that exposes you to margin risk. So maybe the margin trade actually works better in theory. All right, let's take a look at whether there's any more positions that need to be trimmed. No change in plan on these covered calls. I'm going to hold them right up to July 31st. And that's like as much theta decay as I can let drain out of these. If strategy runs back up again to 450, then them's the breaks. But that is the plan. So nothing to really do here. Why do I have $155 of margin use? Oh, probably because this is the one where I just lost $500 on my Tesla trade. That's fine. $100 in margin is no biggie. All right, so this is the IRA. This was the covered call ETF account. So I stacked, I don't know, this might be 60-40 strategy to Tesla. And so, yeah, my shares position are down 10%. My leaps are down like 30%. So that's sad times. So let's go ahead and add, let's see if the covered calls are even worth putting on. If I was running the wheel and selling cash secured puts for next week, this would be about 2% return on capital for a week. So that's actually pretty decent. And I think I will go ahead and add, you know what, let me get my ratios right. So I've got the 250s. They're worth about $100. So as long as I'm in the ballpark of the 350 strikes, I should be good to set up poor man's covered calls here. And then I can add 2 more covered calls and I can select any strike I want. Selling traditional covered calls are a defined risk trade. So let's set up the poor man's covered calls first and see if they're also reasonable for the other account. So if I go to the 350, I would be collecting about 1.5% of the price of of Tesla in about, what's the price of the call? 100. And about 5% return on capital for the price of the call. And I'm going by the current price. I'm already getting wrecked on my cost basis. So I don't even look at what my original cost was. The fact that I'm collecting $500, I could get a little bit more aggressive with this and pump it to, or push it to the 345. But 350 is a nice round number. Probably got decent liquidity. So let's do, is it 3 of them? Yeah. All right, now let's see if I want to be more aggressive with weeklies. Is this worth doing? So collecting about 1% return on the current share price, I need to collect about 305 or more. So I could sell, and that's right at the expected move. So I don't hate that. Technically, my cost basis is 330. So if I do get called away at 320, that would be selling at a loss. But like I was saying, once you lose a trade, trying to do too many backflips to fix it can just cause you to lose more money. So I don't really bother. I just keep chipping away at the cost basis. So I'll do 3 of the 45 days to expiration style. That's like Tasty Trade textbook. And then I'll do 2 that are a little bit more collecting a little bit more premium, less upside, and requires a little bit more maintenance, right? I have to look at these once a week. Whereas the ones that are 43 days to expiration, I only have to look at every 2 to 3 weeks, maybe even once a month. So we've got, let's group these up. Performance covered calls. And then because I am bullish on Tesla over the long haul, I'm going to take this $2,600 that I just collected on my short term, and you know what? Which account is this? Okay, yeah, this is the IRA. I'm not going to see this money for quite a long while, so I don't have to worry about withdrawing anything. So I'm just going to go ahead and dollar cost average into the Tesla version of the 1080s. So I've got some June 18th 960s here. I wonder if I should go out even farther, because I can afford... See, with Tesla, I don't have to worry about the Bitcoin's 4-year cycles necessarily. So what have I got? June. How far can I go out? I doubt I can afford 2027. Yeah, that's way too expensive. Ooh. The 2400s. I've got just enough. So I am capturing premium when theta decay is at its highest, under 45 days to expiration, and transferring that theta out to a long way away where theta is very small. So I'm only losing $5 a day on this position. Gaining $90 a day on these positions. Gaining, what is it, $50 a day on this position, which is offset by the loss of $22 a day on the long calls. All right, I think I'm good with Tesla. And strategy, same situation. Oh yeah, I sold this weekly. There's $27 left in this thing. I guess I'll just wait. This is the one that I accidentally sold 3. So let me just close one. Yeah, so I've got 2 covered calls against 200 shares. And then I've got 4 of the 350s. That was a little bit aggressive buying the 350s. I probably should have bought closer to the 300s. If strategy craps out over earnings for some reason, these could suffer big time. But oh well. I'll roll these probably tomorrow, if at all, or maybe I'll just leave them uncovered all week. If I put them back on, then I just got to make sure I take them off on the 31st, along with everything else. All right, still just hodling the ever-living crap out of these put credit spreads. They're holding on for dear life. With 22 days to expiration left, I should consider rolling these. Let's see if I can. I doubt I'm going to be able to roll them for a credit, though, so I might have to just keep waiting. Oh, well, if I roll them, yeah, this is a pretty aggressive roll, though. I'd be rolling to the same strikes. I would just be rolling out. Can't even roll up. Well, I guess it would be out and down. I can still snatch a tiny little credit there. Oh, no, wrong way. Yeah. Yeah, if I roll to the exact same strikes, it's basically just kind of breaking even. So I think I'll give it another week. Same deal here. I'll just hold on to these covered calls until the 31st and then take them off. I wonder if I'll even have enough cash to take these off. We'll see. We'll see if the price cooperates. All right, this is the challenge account, and I'm free to do whatever the heck I want with this one now. I should probably sell the share and get rid of that $144 worth of margin. But I can kick the can down the road. It's going to cost me a bit to close these. That's going to cost me about $4,000. I might end up having to close one of these poor man's covered calls before earnings anyway, just so that I'm not using margin in this account. Or I could just sell the shares. One way or another. Or I could just use a little bit of margin. That probably wouldn't be the end of the world. We'll see. See, Grok has to be wrong and thinks you can keep the dividend. Weird. The only one of these I'd buy on margin is STRK, which Dan went super deep on. Interactive Brokers has a 5% margin rate for his account, so it's an ARB. Yeah, that's a decent rate. What's up, Scott? I think the trade is to margin on STRK before the declared dividend. Hold until the pay date with all of the drip taking place. Strike runs back up. Sell strike shortly after. Buy strategy in rotation on more Bitcoin buy of strategy. Kind of a kiting trade. Yeah, I've seen those dividend plays. I don't know. Is anybody be able to make those work? Because usually the price runs up before X dividend. So you end up overpaying and then the price drops out. But then, like you were saying, the drip pumped the price back up. So as long as you can get in and out at the same price and collect a dividend, I guess that would work. What's up, Dan? 8:30 a.m. in paradise. Oh, jeez. Like my coffee, like my men. Let's see. Like to wait about 9 or 9:30. Oh, Jesus. Okay, this is what we're doing. Nice. Let's see. So anyway, I think we're hitting a bottom on the MSTR IBIT ratio. I don't even follow it. What do you guys get out of it? Are you able to use it to trade at all? Is it it's everything is good to know, I guess, but is it tradable? That's really the important thing. Is it something that you can use to your advantage? All right, so the 5K account, you know what might be the real challenge is end of 2025, maybe halfway through 2026. If it looks like we're about to do a bear market, maybe I'll do another 5K challenge and see if it's possible to even make money with Bitcoin derivatives over a bear market. It would probably be pretty tough. I'm thinking maybe selling cash secured puts 45 days out 20% below the current price, and just every time you get wrecked, maybe just rolling down and out and just seeing if you can keep your head above water. Or hell, maybe selling call credit spreads. We'll see. Maybe that'll be fun to do. CLSK looks like I'll be assigned some shares tomorrow. Probably trading under 1250. Oh, it's right at 1250. So coin flip, whether I'll be the proud owner of 100 shares of CLSK on Monday. If I am, I'll just move on to step 2 of the wheel and sell a covered call against it. I've got all of these ASST positions, and let's just look at the 2 option position. It looks like this is still kind of doable. They actually paid me $1.80 to take a synthetic $5 stock position. So like the break even here should be like 320. Yeah, break even price. So as long as ASST doesn't lose its its price down below 320, this will be a profitable trade. I guess people were just shorting it so hard by buying puts that the price of the puts just skyrocketed, which made this kind of a weird trade. Normally, when you create a synthetic, you actually pay for it, not get paid for it. So receiving a credit to purchase a synthetic stock is kind of weird. But the next thing that allowed me to do is, now that I have a synthetic long position, which is exactly what the covered call ETFs use, now I can sell covered calls against it. So I think I have 3 of these positions, which is probably too much for an account of this size. But yeah, so I have 2 synthetics here. I also had already taken, I sold a couple of puts, so I might end up actually getting assigned these shares on August 15th, which would be fine. I'll just go to step 2 of the wheel. And then based on these 2 synthetic longs, I started selling covered calls. So I sold a $5 call and I sold a $7.50 call. Probably end up having to roll this 7.5 down to the $5 strike. Oh, it's actually still right where I sold it. The price hasn't changed. The only thing that I don't like about this particular ticker is that the ticks are in nickels, so it makes this harder to trade, and it's so cheap that with a small credit, it's a pain in the ass. You know, if you think the mid price is 18, well, you can't get 18, so you have to go all the way to 15. So just it kind of eats into your profits. So if this particular trade starts to piss me off because it's too inconvenient to trade, then I'll just dump it and call it a fun experiment. I've got the CLSK and Riot puts that I sold out to 822. Those are the ones I'm copy trading with my brother-in-law, trying to teach him the wheel. And then, of course, I've got my poor man's covered call in strategy, 300 strike. And I've got 1 covered call against it somewhere up here. Yeah, if I can afford to take this off on the 31st, I will. I guess worst case scenario is I would have to sell my 100 shares of CLSK, or maybe that'd be a good excuse to sell this damn GameStop, this ill-advised GameStop trade that I ran the wheel in. One or the other. But I think the premiums on GameStop are not terrible. They might be a shit company, but just going out to next week, yeah, 2% return on capital for 8 days. It's not terrible. Pretty standard for the Bitcoin derivative space, I think. All right, we'll call that good. Only thing I did today was take my medicine and close that Tesla earnings trade for a loss. Let's see. Yeah, for a bottom, it is suggestive. I forget what the hell we were talking about. MSTR IBIT is tradable to me, at least. Gives me a better idea of market bottoms than strategy to dollars. The puts were expensive because folks were buying insurance for their $10 ASST shares they bought. Yeah, that makes sense. Oh, so they were buying it at 10? Is that what it pumped to? So they were just putting protection on their... Yeah. God, so there were people just FOMOing into this at 10 and then capping their downside by buying $5 puts or whatever. Okay. Let's see. I had the same trade with Sequans, paid to get the synthetic. Yeah, I think Emperor loaded up the truck on that one. He was trying to tip me off to it. Let's see. Been eating good on these sequence leaps. Sequence is very, very hidden from the public eye. Yeah, you can't even get it on Robinhood. I think I can trade it on Tasty, but I haven't bothered. Swan Ben will push sequence from here. More info upcoming as I understand it. You know what's kind of sad is I should know more about what the fuck is happening. I might have to hit him up. Let's see. I'm looking forward to hearing more about Sequans and how they are performing their strategy. All right, cool. Grok is fun to talk to. I've been constantly working with it and asking it stuff, but you do have to double check. You have to check the work. So I think this one was fun to talk about, but I think this one was probably better left in theory than actual practical execution. So better luck next time, Grok. All right, that is it for now. And appreciate everybody tuning in. Be good, Joe.